Part 4, Long-Term Contracts. Revenue recognition over time with overall profit for percentage of completion and completed contract. There are two accounting methods available for long-term contracts. We call it percentage of completion, which is the preferable method if you can meet the criteria, which recognizes revenue and gross profit over time based on meeting defined milestones and both the buyer and seller have enforceable rights, or completed contract, recognize revenue and gross profit only after the contract is complete. Now, Step 2 and 5 of the revenue recognition rule are critical for long-term contracts. First of all, you have to identify the performance obligations. Usually have a single performance obligation because don't meet the separately identifiable criterion necessary for goods and services to be used as distinct. So, you may have only one performance obligation, but what helps you is Step 5, which means you have to recognize the revenue when each performance obligation is satisfied. So, recognizing revenue over time according to the progress toward completion. Long-term contracts qualify. Recognizing revenue upon completion, which is if you don't meet the criteria. Now, you can recognize revenue over time, use percentage of completion, if the customer simultaneously receives and consumes the benefit of the seller's performance as the seller performs, or the company's performance creates or enhances an asset, for example, work in process, that the customer controls as the asset is created or enhanced, or the company does not create an asset that can be sold to another customer. If the performance obligation doesn't meet any of the three criteria for recognizing revenue over time, then recognizing revenue at a point in time when the performance obligation has been completely satisfied. It usually occurs at the end of the project. So let's take a look at an example. Shanahan Construction Company has entered into a contract beginning January 1st of 2019 to build a parking complex. It is estimated, based on previous experience, the complex will cost $600,000 and will take 3 years to construct. The complex will be billed to the purchasing company for $900,000. The following data pertain to the construction period. First of all, we know it's going to cost us $600,000. It's going to take 3 years, and we're going to be able to bill them a total of $900,000. So, here is the actual cost, estimated cost to complete, progress billings to date, and cash collected to date for each of the 3 years. So, since it says cost to date, that would be the cumulative amount. When you look at cost, now sometimes they'll say only the cost for the year, so please pay attention to the information provided. Now, step 1, determine percentage complete. You need the cost to date and estimated cost to complete. So, here's the information we have. Year to date, we have estimated cost to complete, and then we have total cost for each one of the 3 years. Step 2, determine the percentage of revenue to be recorded each year. The formula is year-to-date cost divided by total estimated cost to complete equals percentage complete. That's the number you're going to use to figure out how much revenue to record. So, here we go. Total revenue is $900,000. Determine percentage revenue earned 2019. 2019, we would take the $270,000 divided by the total cost of $600,000. That tells us that it's 45% complete. Now we can determine how much revenue to book. We're going to book $405,000 because we're going to take the total sales price, which is fixed, times 45%. That's how much revenue we're going to book in 2019 for percentage of completion. less our current year expense, which tells us we're going to have gross profit of $135,000 in 2019. Now, let's look at the next year. We have total revenue of $900,000. Determine percentage complete, 450 divided by 600,000 gives you 75% times 900,000. We now have earned a total for both years of 675,000. What that means is we do need to for getting current year, we need to back out any prior year revenue that we have booked. And so for the year, we're going to book $270,000. Less expenses, so we're going to have gross profit of $90,000 for the year 2020. Now we're going to do the last year. Again, remember you must always subtract out prior year to date. Now we're 100% complete, so we can recognize all of the costs. Now, determine the revenue. We're going for 2021, it's going to be $900,000 minus 2019 and 2020's revenue. So we're going to be able to record $225,000 in 2021, less the expense that's left over, which is the 2 prior years. And that tells you for 2021, we're going to record $65,000. Now let's take a look at our journal entries. Here's what they look like. When we start, we would have booked our expenses into construction in progress. And then when we bill the client, we're going to take it against billings on construction in process. When we get paid, it's going to reduce accounts receivable. And when we book the revenue, we will then debit construction in process and construction expense. And then at the end of the period, we're going to zero out billings on construction and construction in process. So, this is an asset until the contract is completed and therefore has a cumulative balance. And gross profit is always a debit to construction in process because the billings and construction in process must equal at completion of the contract. So now let's take a look at our 2 clearing accounts. We have construction in process and billings on construction in process. So here's what we look like in 2019. In 2020 and 2021. And in the end, if you notice, they both have $900,000, and then we can do our journal at the completion of the contract to clear them out. Now, what if we had done completed contract? What would it look like? Well, the thing to remember with completed contract is we don't book any revenue until the end of the product. So, we would be booking construction in progress and billings on construction for each of the 3 years, and we would not book any revenue until the contract is complete. So here's what it would look like in their T accounts. Same journal to clear them out. Now, let's take a look at what it looks like for percentage of completion and completed contract. So, same problem. Under percentage of completion, this would be the revenue we would show, and this would be the gross profit we'd show in the books every year. For completed contract, we would show no revenue at all until it is complete, and we would show no gross profit. The total revenue and profit are the same. The only difference is when it can be recognized. Now, what if there is a total overall loss on a contract? Percentage of completion requires an adjustment to reflect the year-to-date loss. Completed contract, no adjustment. Now, this assumes that we have a contract that there will be an overall profit. Even though there's a loss in the period, overall, it's going to make a profit. But what if there is going to be an overall loss on the contract? Then for both of them, you have to book the loss in the period it occurs. But under completed contract, you still do not book the revenue till the last year. All you book is the loss for completed contract. This is covered in Part 5, which is the last part of this presentation on revenue recognition.